Hi there, I'm Mark Sebastian, the founder of OptionPit.com, and this is the Option Pit webinar of the month, Trading Daily Options, the Option Pit method. I'd like to remind you that this is for educational purposes only. None of this should be construed as investment advice. Consult your financial professional. Options have risk. So for those of you who don't know who I am, this is me, that handsome man. That guy's a lot more relaxed because he doesn't have 2 kids. He's not being forced to do a webinar outside, and he's hanging out in New York. But all the same, he's having himself a nice day. So here we are. This is me. Option Pit is an education and consulting firm. We deal with professional and institutional clients with strategy optimization, strategy implementation. And then for retail traders, we try and teach you the way I was taught to trade. So we try and take a professional approach to retail trading. All right, that is our approach. So we're going to talk about what are daily options, how the time value decays, where the pricing model doesn't work, the advantages of using daily options, disadvantages, some basic use of dailies, and some daily overriding. So what are our daily options? There are 2 types of daily options. Options that list one day and then expire the next day. Those are daily options. Those are binary generally. Those are generally binary options that might trade on Nadex. And then the ones that I'm interested in, the one I think are going to really take off, are options that expire daily. So what's the difference between options that list one day then expire the next and options that expire daily? These are options that are listed at varying times, usually weeks out, but they list them all the time, so the next thing you know, there is an option expiring every day. Right now, these exist essentially in SPY and SPX. All right, so right now in SPX, there can be as many as 4 expirations in a week. All right, and there can be as many as 3 in SPY. How can there be 4? Well, so take a look at the end of the month. You've got Monday's the 26th, Wednesday's the 28th, and Friday is the 30th, but the 30th is also a quarterly option. So if for some reason the 30th fell on a Thursday or a Tuesday, let's just say Thursday, you would have an option that expired on a Monday, a Wednesday, a Thursday, and a Friday. So there are tons of options that can expire, up to 4 in a week. So now, just be aware that not only do we have up to 4 in a week, where do you think we're going from here? You think they're going to add more? Absolutely. These are going to be trading. There will be an option expiring every day in the SPX, the S&P 500 futures options, and SPY well before this time next year. I don't think they'll do hourly. I think daily is about where they stop. If you want to do hourly, that's basically a binary option. So then, the next step, this will eventually pour over into equity options. There will be equity options that expire, on Wednesdays next, and then Mondays. Then they'll add those. This is where this is going. So the purpose of this webinar is to help you get out ahead of the curve. And we're going to talk about the nuances of daily options and what you need to know. So before trading daily options, you need to have a really strong understanding of the concept of decay. All right. The concept of decay, it's often presented as simple, but it's really rarely the case. Decay of options is nuanced and the key to forming trades around daily options. All right, so now, options are just another form of insurance. As time passes, insurance policies lose value. All right, even on the last week or the last day, insurance policies still have some value. Much like insurance policies, options decay with the passage of time. All right, up to the last minute, an at-the-money option will have a lot of insurance value. So how do at-the-money options decay? All right, you've got option time decay, days until expiration. And everybody knows, oh, well, as we get closer to expiration, decay becomes exponential. That is true for at-the-money options. All right. So at-the-money option decay is exponential. This is one of the real values in trading daily options. You are literally selling. If I sell an option on Monday morning that expires Monday afternoon, I'm catching the absolute peak of decay. I'm catching the complete point where it has gone completely exponential. However, that's not entirely true. In theory, one should be able to harness lots of premium, especially for at the money, but doesn't always work that way. So for starts, is that really how option decay works? Is it that easy? That this chart is for at the money. All right. It doesn't apply to options that are out of the money. And in the daily option, something that's just a little bit out of the money can have a very small delta. So there is so something with a very small delta that's just at the money, its decay can change. So what I want you to notice is that out of the money options have a linear decay, and you've got that exponential decay at the money. Both at the money and out of the money sheets can decay to a point where they start to act like a coin flip game. All right, let me talk about this coin flip game. So if I flip a coin, if I flip a quarter, and heads you get $1 million, tails I get 900,000. You only get to play it once. Would you do that? So it's got a positive expectancy, but how many of you would bet 900,000 to win $1 million? You know? Right. Right. Now, what if I let you play that game 500 times before we settled up? Everyone said no to the first one. Yeah, then you'd play. Because at that point, you start having a really positive expectancy, all right, has time to win. All right. So market makers think the same way. Yes, if they sell a nickel option, they'll probably win. Oh, statistically, they will win. But that little nickel option can blow up on them. All right, and so they don't, and they get charged a lot of margin for them. So they don't like selling cheap options. So going into expiration, even for an option that's just out of the money, the decay kind of looks like this. So up to the last minute, you know, a option that should be technically worthless can be worth 10 cents because the market makers don't want to sell it. All right, pretty simple. So let's circle back to what we learned and discuss where the edge is in weekly and daily options. In the last week of an option's life, it has huge amounts of decay at the money. In the last day. This applies to dailies as well. But we're going to look at weeklies because we have a lot more evidence of that. All right, out of the money options decay linearly. I'd have to show you the chart of this on an intraday basis in order to... I'm going to have to be looking at this in a live environment for me to show you how this works for dailies. But out of the money options decay linearly, making this week and last week very similar. Thus, not much edge in selling out of the money options. And the last nickel doesn't decay forever. So this is General Motors. And I want you to notice the at the money option. So General Motors trading right at 36. So the April 10 calls have 2 days to expire and they're worth 28. The May 1 36 calls are worth 90 cents and they have 22 days to expire. So I rather collect 28 cents for 2 days or 90 cents for 22 days. What's the better trade there? Yeah, simple. The 2-day trade's way better. Yeah, the 2-day trade is way better. All right. Now, it's not that simple, but generally speaking, I'd rather get 28, if I do 28 cents every 2 days, how much would I collect? I'd collect 28 cents 11 times. It's almost, that's like $3 versus 90 cents. So now, let's take a look at some out of the money. Now, here's GM 37s. So strike out. And what I want you to notice is the April 37s, these have 9 days to expire and they're worth 14 cents. Whereas the regular May 37 calls with 22 days to expire are worth 51. So would I rather collect 14 cents over 9 days or 51 cents over 22 days? Right. Trade number 2 is better. So that concept of exponential decay just doesn't apply to weeklies and dailies in the same way. All right. And that's one of the reasons why if you want to play in dailies, if you want to play in an option that expires the same day, you really are stuck with at the money options. Meanwhile, out of the money options, take a look at these cheapies. And so look at these. They're worth 3 cents. And they're way out of the money. So all the way up to expiration, take a look here. The 37, so these have 2 days to expire and they're worth 3 cents. So if I sold that option at 14 cents, 7 days later, it's still worth 3. So really, I'm only collecting 11 cents. It's terrible. So don't sell the way out of the money junk because it takes a lot longer to decay than you think. And if you're going to go out of the money, if you want to sell out of the money options, you're better off moving your duration back. If you want to sell near the money options, you're better off moving your duration forward. All right, do we all get that? I actually want to add that as a slide. Now that oh yeah, here we go. So dailies and weeklies are for near and at the money options. That's where the edge is. If you're selling out of the money options, you're giving away money and should be in back months. Teenies will take forever to decay. So if you are a roller, so if you constantly have stuff on and you're like, I don't want to pay commission, so I'm going to wait for these to expire worthless, you're probably actually leaving money on the table. So if you sell an out of the money option and let it expire, rather than selling it out of the money option and buying it for 5 cents and then rolling back, you're actually leaving money on the table. Now, there may be some strategies for selling cheapy options, but I'm not going to cover those today. They're a little more pro. So daily versus weekly versus monthly. Should one always sell dailies or weeklies options when one is trading near the money? What about covered calls and cash secured puts? There is a trade-off. Now, in return for the extra premium, you're getting lots of exposure to price movement. Lots of exposure to price movement. Thus, if all goes right selling those daily options, you're going to make a ton of dough. If all goes well selling weeklies, you're going to do really well. But you make less selling a monthly. So, the more, if all goes right, you make the most selling dailies, more selling weeklies than monthlies, and the least selling a monthly. However, what if the underlying really starts to move around? The monthly has much more raw premium. That means, yes, if you got to trade the daily over and over and over again, you make a lot more. But just the straight sale of the monthly, you collect more dollars. Thus, you can wait out a pop, you can worry, you can sit on it. A daily or weekly option just expires, and it may take one stock if it's not bought back. Or worse, the trader covers, then the underlying drops again. Or rallies. Dailies and weeklies are for seasoned traders because the gamma, that price exposure, exacerbates the problem. And you need to close worthless options. And worthless is less than a nickel. So you sell a daily option, it gets to be worth less than a nickel, buy it back. Gets to be worth less than a dime, you probably want to buy it back. Question is, when did they start dailies? They listed Wednesday expiration last year, Monday expiration this year, and they have had quarterlies forever. I think Thursdays are next. The daily edge. The real edge in daily options is strategic placement of an option trade. One can pinpoint where one wants to take long risk and short risk. Now, the nice thing is these expirations go out different weeks. I can pinpoint when I want to put on risk. So I can gather information. So we had the Fed on. We had the Fed. This I took last week. And this was an option that expired on the 23rd. So yesterday. All right. The market was looking for a $48 move by 2120. Relative to this move. So what did we get? Where is SPX? 48 bucks. Where did SPX end up? 45. And it was actually above that level leading into this on Thursday. So not bad. All right. So now the nice thing is, look at all these different expirations I can now trade around. All right. I don't want to trade. I think the S&P is going to rally. I don't want to trade. I can actually see where the event risk is. Event risk. So, and then I can trade, so I can buy the October 7s, which have non-farm payroll, and I can sell the September 19s against it, which don't have FOMC. So I want to play non-farms. You know, I can actually set up my trades around what I'm looking to do. So now I think one of the real ways that you guys will be able to use dailies, especially once they're added to equities, is in AM, PM call writing or put writing. So the market today, not today, but the market on the day that I wrote this opened up about 4 points. Put the S&P 500 right at 2131. I could sell the 2140 calls as high as $5, or when the market backed off, I could have covered the trade for a nickel. So like, let's look at yesterday. You know, these expired yesterday. But let's look at the progression of like the 21. We open of like the 2185s. Remember, we were down 12, so we actually opened up 2176. The 2185s, well, they were a quarter. So let's look at the 80s. They were as high as 75 cents. The 75s, you want to sell right at the money? Look at that. They trade as high as 255 and you bought them back for a nickel. So there are ways to overwrite. Because I think we opened down. So another one would be strategic put selling. So on the low of that day, the 2120 puts traded over $4. I could sell them. Again, by 2 p.m., one could have covered them for less than a dime because of rapid decay. So let's look at what happened yesterday. Let's look at the 2160s, which went out at a nickel. At their peak, these were $1.20. And the 65s that went out basically worthless. Trade as high as $3. The 70s that went out over $5 traded as high as $6.40. So, you know, selling these in the morning and buying in the afternoon as a trade actually may work because of that rapid decay. Yes, it is a timing trade. It is a timing trade. So we'll talk about that. Question, there's lots of risk is the person. So the risk, while one might be able to do this trade over and over again, there is always the risk underlying moving hard. All right. So this is not a trade you do when there's a lot of momentum in the market. And you have to, and really, I think the better way to do it is take quick profits. Take $1. Take $2. It is very easy to take $1 or $2. Much easier than trying to get the huge amounts that can be available. All right. Don't execute in a momentum market. So like Wednesday out of the Fed, when we were up, that was it would have been a terrible idea. It seems to me daily expirations will encourage HFTs to turn their attention to scalping option premium. Maybe. I could see that. The thing about HFT is it is a lot more related to payment for order flow games than it is actually trying to make money. You could sell these against longer term XPX. Yes. There's all sorts of interesting ways to set these trades up. And then one thing I do is I leg into spreads. So around the Fed, what I actually ended up doing was putting on a butterfly for free that I then sold at over $1. So I legged different pieces of it as the market moved around. So what do I like them for? Strategic overwriting, the wheel, flies, calendars and double calendars, and directional calendars. These little dailies can mitigate so much cost if done correctly. Leg into spreads meaning debit or credit, yes, or butterflies, or calendar spreads. So in summary, decay is nuanced. Many people understand that, but don't realize it. Dailies can be good for credit and debit spreads and some strategic placement, and are great to finance directional opinions. So it's no longer the 24th. It is October 1st at 9:30 a.m. Eastern Time. Andrew and I are going to do a Saturday class on daily options. And it's going to be 3+ hours, 4 hours, and we're going to dig deep into strategy. Yes, you can get the slides. So all right, and let me answer some questions here. So you go to optionpit.com/dailies to sign up. It's $167. Use code 25_off, 25_OFF cat. It is case sensitive. It is case sensitive. These could be really interesting for verticals. Absolutely vertical spreads. What's the wheel? The wheel is when you sell a put and then sell a call, and to get in and out. I could see a lot of value in that. How do you feel about a hedged risk reversal for one day, since it will gain or lose almost immediately? That's an interesting idea. Doesn't commissions factor into this? I never consider commissions. I work to get my commissions as low as possible, and then I forget about them. And if you have commissions as such that they stop you from trading, you need to find a new broker. So the nice thing is we really see this as a value, not just as trading the day of expiration, but setting up trades all across different time frames. Where we have a Fed meeting, I can sell the Wednesday option and buy the Friday option. I mean, there's so much we see in calendar spreads, in daily credit spread trading, the session is recorded. Day trading margin rules are important, and that's the nice thing, is that there are, you'll be in and out of this stuff. So, and we're also going to talk about risk. This is going to be really good. Whenever a trade changes into a new trade, does the new profit potential push older trades' profit potential off the stage? AG. In a straddle that gets changed into an iron butterfly, the profit potential of the straddle is no longer considered, and only the iron butterfly's potential is considered. That's usually the way I approach it. I think about what I net own things for. It's daily, not dailies. Excuse me. Let me see. Yeah. Oh, it's daily, not dailies. I'm sorry. No S. But I'll add a redirect just so that nobody... Please comment on binary options. I'm not a huge fan, but I'm not a huge fan, but there are gonna be some opportunities to trade them where they can be offset against daily expiration, and you can create some arbitrage. I think there's a lot. I think that is going to be an interesting thing. Is will trading binary options versus daily options and hedging the two off of each other. Is there adequate room to run in daily? Is the one-day move price? Yeah, no, there is. There's plenty of room. And right now they're SPX and SPY only, but that is going to change. All right. Yeah, it's the one-day move. No, a one-day move is going to basically be the at-the-money straddle price. That's going to be within the at-the-money straddle is about is going to be the right price, or maybe a little bit more, about 58% of the time. So yeah, maybe 0.8, 0.9, something like that. Yeah, it gives you a real idea of what the market thinks. Well, I'm glad you enjoyed too. Check out the course. If you've not taken our coursework, this is really good. And if you take the course and you hate it, I will make it up to you guys. So go to optionpit.com/dailies. Is this day trading or expiration day trading? We're going to cover the day trading use and trading dailies over longer periods of time. It's /daily. No, it's there. Is there a way I can buy the course and get the... Yes, you can watch the recording. For sure. The recording is here to keep. After the course is over, you get to keep the recording and the materials. It's going to be really good. Are you covering like diagonals? Yeah, I think we're going to kind of hit everything that we can. Because Andrew and I definitely think diagonals in daily options make a lot of sense, especially in SPX. Yeah. Well, dailies, it should redirect. So if you put in dailies, it will redirect to daily. Just interested, how is your $30,000 account doing? That you did a year and a half ago with SIBO? I don't remember that. I run a hedge fund, and we're doing fine. We have, are you talking about, I haven't looked. We put that show on hiatus, but it was, the link is, and the code is 25_OFF. Yeah. I haven't looked at it in a while.
Good morning, boys and girls. Welcome to Volatility 411.
I'm not sure why that's showing up. So, it is, I have no idea. It looks like we did okay. I've not looked in a while. Yeah, you can see I haven't done one in a couple of months, but we were doing pretty well there. I'd have to look at the stats. All right, any other questions? There you go. All right, guys. See, look at that. In and out in about 40 minutes. Can't ask for more than that, can you? And I got you some, and I made a couple educational points. So go win for us. All right, guys. Any other questions? Then we'll run out of here. Is there any disadvantage if we don't attend live? No, because you can email me questions. Obviously, it's always better to attend live, but you can email me questions. How do we get the slides? Shoot me an email. I'll send you these slides. mark@optionpit.com or info@optionpit.com. All right, guys. Have a great morning.